Look at the room around you, everything, your phone, that coffee mug, the shirt on your back. Almost every single object within your reach shares the exact same secret backstory. It spent days, maybe weeks, trapped inside a heavy steel box floating across an endless ocean. But here is the part you aren't supposed to notice. Before any of those items could reach your store shelves, they had to pass through a highly secure, heavily guarded choke point. A place where a private entity, one you have likely never heard of, charged a completely unbypassable fee, just for letting that item touch the ground. Think about it. We are obsessed with tech companies, AI startups, and real estate moguls. But while Silicon Valley bleeds cash trying to acquire users, a silent group of infrastructure titans is quietly extracting billions of dollars from a business model that hasn't changed fundamentally in 500 years. It is the ultimate economic cheat code, a legal monopoly, hiding in plain sight. But how does a simple patch of concrete beside the water turn into a money-printing machine so powerful that even the world's largest investment funds are begging for a piece of it? The answer lies inside a hidden financial architecture that guarantees profits even when the global economy is crashing. By the end of this video, you will look at global trade completely differently. We are going to peel back the layers of the maritime shipping industry to reveal the exact mechanics of port ownership. You will discover how these giant concrete toll booths structure their fees, how they trap global shipping lines into contracts they cannot escape, and why owning a port is arguably the most resilient, hyper-profitable business model on Earth. To understand the sheer scale of this business, we have to look at a staggering reality. Over 80% of all global trade by volume is carried by sea. Let that sink in. If maritime shipping stops, civilization stops. The global port market isn't just big, it is the literal foundation of modern capitalism, valued at well over $150 billion annually. Yet most people completely misunderstand what a port actually is. They see it as a government service, a public utility, a boring piece of infrastructure where blue-collar workers move boxes. That is a massive illusion. In reality, ports are highly sophisticated, ruthlessly optimized financial assets. Investors don't buy them for the ships, they buy them because they are irreplaceable bottlenecks. If you want to build a new app, you just need code. If you want to build a competing port, you need billions of dollars, decades of environmental approvals, and a perfect deepwater coastline that usually doesn't exist. This absolute scarcity is why institutional investors, sovereign wealth funds, and private equity firms treat ports like pure gold. They aren't looking for high-risk tech growth, they are looking for predictable, inflation-protected, multi-generational cash flows. So, who actually owns these global cash registers? It is a fascinating mix of public land and private greed. The most dominant framework is called the landlord port model. Under this structure, a local government retains ownership of the actual physical land. Because letting a foreign corporation fully own a nation's coastline is a geopolitical nightmare. Instead, the government signs a hyper-exclusive, long-term lease, often lasting 30, 50, or even 99 years with a private port operator. Companies like DP World, Hutchison Ports, or PSA International, once the lease is signed, the private operator takes total control of the zone. They bring in their own cranes, their own technology, and their own management. Now, how does the money move? The private operator pays a steady, predictable rent back to the government. But the profits they extract from the shipping lines, that money bypasses the local economy entirely, flowing straight into corporate bank accounts in Dubai, Hong Kong, or Singapore. It is a brilliant extraction mechanism. The government takes the long-term sovereign risk, while the private operator takes the pure commercial upside. But where does that upside actually come from? Let's break down the revenue engine, because this is where the toll booth model becomes truly sinister. Imagine a massive megaship carrying 20,000 containers arrives at a port. The moment that ship crosses an imaginary line in the water, the cash register starts ringing. First, there are marine fees. The ship must pay for pilotage, hiring a local expert to steer it safely into the harbor. It pays towage fees for tugboats to push it into place. And it pays berthing fees, which is essentially the world's most expensive parking ticket, calculated by the hour based on the length of the ship. Next come the handling fees or terminal handling charges. This is the core revenue stream. Every single time a giant crane lifts a container off the ship and places it on the dock, the port collects a fee. Typically between $150 to $300 per lift. Multiply that by thousands of containers per ship, and a single vessel can generate $500,000 in handling fees alone, in less than 24 hours. But the real genius of the port business model is storage fees, also known as demurrage. A port is not designed to be a warehouse, it is a transit zone. Space is extremely limited. So the port gives cargo owners a tight window, usually 3 to 5 days, to pick up their containers. If a truck is late, if customs paperwork is delayed by a single hour, the port begins charging astronomical daily penalties. The container is stuck, it cannot leave, and the money just keeps piling up. The port literally makes millions of dollars because its customers are experiencing logistical friction. Now you might be thinking, with all this heavy machinery and infrastructure, the expenses must be terrifying. And you're right, but not in the way you think. Yes, the initial capital expenditures are brutal. A single modern ship-to-shore crane can cost upwards of $12 million. Dredging the ocean floor to keep the water deep enough for massive ships costs fortunes. But once that infrastructure is built, the operational margins are incredibly sweet. Traditionally, the biggest variable cost was labor. Longshoremen and crane operators wielded massive leverage, frequently going on strike to demand higher wages. But modern port operators have found the ultimate antidote: automation. Walk through the world's most advanced ports today and you will notice something deeply eerie. It is completely silent. There are almost no humans. Giant automated guided vehicles move containers across the tarmac using magnetic grids. Automated cranes stack boxes with millimeter precision, guided by algorithms. By eliminating human labor, ports have transformed their cost structure from an unpredictable variable expense into a fixed, highly predictable and highly optimized line item. The regulations are intense, and environmental compliance is a constant headache. But when your primary asset is durable concrete and automated steel, your maintenance costs become remarkably manageable relative to the massive volume of cash flowing through. This brings us to the core secret. Why do these assets routinely command multi-billion-dollar valuations? It comes down to 3 words: inescapable economic moats. When a port establishes itself as the primary gateway to a region or a continent, it triggers a massive network effect. Shipping lines want to go where the inland rail and highway connections are strongest. Trucking companies want to go where the shipping lines drop off the most cargo. This creates a self-reinforcing loop that builds a fortress around the business. A port doesn't have to spend millions on marketing or customer acquisition. Its customers have no choice. If a shipping line decides to boycott a major port, they are effectively boycotting the entire economic region that the port serves. Furthermore, port revenues are naturally hedged against inflation. In almost every concession agreement, the port operator has the legal right to automatically increase their tariff rates in line with inflation. If global prices rise, port fees rise instantly. It is a recurring revenue stream tied directly to human consumption. As long as people keep buying goods, the port keeps collecting tolls, but no empire is completely invulnerable, even one built on concrete. The toll booth model faces very specific existential threats. The first is geopolitical volatility. Because ports sit at the very center of global trade, they are the first to bleed when trade wars erupt. If 2 major economic superpowers decide to slap massive tariffs on each other, container volumes drop, and remember, fewer boxes lifted means fewer fees collected. The second threat is vessel size inflation. Shipping lines, desperate to achieve economies of scale, keep building larger and larger megaships. But these monstrous vessels place immense pressure on ports. If a port doesn't spend hundreds of millions of dollars to deepen its channels and buy taller cranes, it becomes instantly obsolete. The shipping lines will simply take their business to a competitor down the coast. It is a constant, high-stakes arms race where the port must continually reinvest capital just to protect its monopoly. So, where is this industry heading? The next decade of port ownership will be defined by a shift from physical real estate to digital dominance. The most valuable ports of the future will not be judged merely by how much land they control, but by how effectively they deploy artificial intelligence. We are already seeing the rise of predictive logistics. Software systems that analyze global weather patterns, naval speeds, and inland traffic to optimize the exact minute a crane should begin moving. But there is an even bigger play happening. Major port operators are no longer content with just controlling the coastline. They are vertically integrating. They are buying up inland rail hubs, trucking fleets, and digital customs platforms. The goal: to control the entire supply chain from the overseas factory floor straight to your doorstep. They want to turn the entire planet into one giant seamless toll road the next time you track an online order, or watch an Amazon delivery truck drive through your neighborhood. Think about the invisible journey that product took. Think about that quiet, heavily automated strip of coastline where a massive steel crane lifted a box from sea to land. We live in a world where tech founders and stock market trends dominate the headlines every single day. But the real power, the true, unshakable wealth, belongs to the entities that own the physical bottlenecks of the world.